So what is going on in today's real estate market? Hey, what's going on, guys? This is Daniel, one half of the Quack Brothers, and I got a lot of interesting facts, articles, and research that I put together for you guys to enjoy today in terms of what is actually happening in the real estate market. So of course, guys, I'm gonna have to say it as is with tradition in every single video. Please subscribe to our YouTube channel. All right, we got that over with. Let's go ahead and get to the actual content. So I'm gonna give you guys pieces of information that I am seeing personally myself, things that I'm experiencing out in the real estate market, along with a lot of articles and research that I put together for you guys to enjoy. And I'm going to finish off this video at the end what I believe you guys should be doing as action steps to really take advantage of this opportunity. You know what they always say, never waste a crisis. So let's go ahead and start from the top. I'm going to be talking about both residential and commercial real estate. So let's go ahead and first start with the residential market. Okay, so let's first start with home construction, because one of the things that stands out to me when I'm looking at the supply and the demand curve in the real estate market, which, by the way, guys, if you are an amateur real estate investor, you're just starting out, one of the biggest pieces of advice I tell to investors just starting out is first look at the supply and demand. Everything you should look at through the lens of supply and demand. Let's look at supply and demand, right? Because if you think about home construction, you're really talking about the increase in supply. So let me throw off this statistic at you guys. So home construction is down 20.8% compared to last year. So I actually got that number from the month of April. So if you're comparing April of this year to the April of last year, we are down 20.8% in home construction. So let's talk about that, right? In my opinion, I actually think that might be a good thing. A lot of people might look at that statistic and say, well, it's a down number, right? We're going down compared to last year. That can't be good. In my experience, I think that's actually a very good thing because, well, let's look at the entire landscape of the economy right now. We have 36.5, at the time of me recording this video, we have 36.5 million Americans who are currently under the unemployed category. We have 4.7 million mortgages in forbearance. And I'm going to come back here in a little moment and talk about that $4.7 million number in terms of the residential mortgage market. But let's go back to the construction aspect because, well, if you have 36.5 million Americans that are unemployed, well, that's a pretty big population of the potential home buying market. Because, well, what happens? Because yes, the rates are super low right now. But when these individuals go to a bank wants to see an individual with a steady income. They want to see somebody with good credit, and they want to see somebody who's very not much of a risk. Because of course, we talk about here on the Quack Brothers channel all the time about banks and their ability to assess risk. So if you have 36.5 million Americans who are not employed, they're not receiving an income, and on top of that, and you see the other side of the spectrum, you see all these banks that are making their lending requirements a lot more strict when it comes to getting a mortgage. I mean, some banks are not even taking HELOC applications anymore. So if you look at the overall underwriting process for residential mortgages, it's more strict. You have a bunch of people unemployed, not having a steady income, so they're not even going to pass the underwriting process anyway, or even get pre-approved. In my opinion, it might not be a bad thing to have a 20.8% drop because, well, that's a lot better than having a 0% drop or potentially even having a gain and having all these single family houses sit vacant. Because we got to remember, there's 4.7 million Americans mortgages in forbearance. So what does that mean? It means a lot more empty houses. It means a lot of these individuals losing their house and these houses are sitting empty. So for me, it's not much of a big thing to build more houses when you already have a situation where millions of Americans potentially may be leaving their houses anyways due to financial capabilities. So that leads me to the commercial real estate market. So at this point, you might be asking, well, Daniel, if all these people are leaving their homes, they're getting kicked out because, there's 4.7 million people not able to pay their mortgages or they're in forbearance. And well, what happens when everything, quote unquote, goes back to normal and a lot of these mortgages that have been forbeared or furloughed, these Americans have to pay the mortgages back? What happens then? Well, I see two things happening. And well, these are things that happen in every single recession. Matter of fact, I just finished Ray Dalio's 3-part series on the big debt crises. And I recommend you read that if you want to understand more about cycles and recessions and even depressions. But the two things that happen very commonly when it comes to the real estate market is, number one, the price of the single family home tends to plummet. It drops. Matter of fact, I think the number was 35%. If you look at between 2006 and I think 2008, in a span of 2 years, the average price of a home dropped 35%. So that's normal. Another thing that you see is a migration from individuals owning their home into renting. Matter of fact, one of the things you'll commonly see when it comes to recessionary times is that Class A apartment complexes tend to have a lower vacancy. That's right, you heard me correctly. They tend to have a lower vacancy. Now, don't get me wrong, guys. Are there things that are different about this recession or this economic downturn that's different than 10 years ago? 100%. There's going to be some differences. There's going to be some similarities. And of course, there's this whole rent strike thing going on, although I don't think that's affecting the Class A multifamily or multifamily as a whole. And I'll share with you some numbers as to why I say that. But I do believe that typically speaking, Class A and Class B apartment complexes during recessionary times tend to do great because, well, a lot of these individuals go from home ownership and they go into the apartment complex rental space because they lost their mortgage, or they end up renting a single family house, which, guys, a lot of statistics also point out that there's a lot more single family rentals today than 10, 12 years ago when we had our last recession. So for me personally, it's going to be very interesting to see how it plays out in the single family housing rental market, so to speak. All right, let's move on to commercial. So these are statistics that I've seen across multiple different trusted article sources. And I'm gonna go ahead and list off for you guys some statistics in terms of what is the typical rent that is expected to be paid versus how much are they actually getting for the month of April, which is the last month in which these numbers were reported. So we're going to look at 5 different asset classes in the real estate market and how they're performing in the month of April compared to what is typical in the same asset class. So let's go ahead and first start with apartment REITs. Now, again, guys, I'm not talking about Mr. and Mrs. Jones who owns, a duplex and a couple single family house. I'm talking about the Blackstones of the group, right? The large real estate investment trusts that own billions of dollars worth of assets. So apartment REITs actually collected 95% of the typical income that they would in an average month, right? So let's say that in January of 2020, when before all this, pandemic stuff happened, let's say they were collecting $50,000 in rent for one apartment. They collected 95% of that in April, which is pretty darn good. I think, I can speak for myself and a lot of other people that we expected that number to be lower. Now, of course, guys, keep in mind that we're talking about REITs here, right? So typically these organizations, these real estate investment trusts are typically owning Class B and Class A complexes, meaning that these are individuals who may have the financial capabilities to pay the month's rent compared to the Class C or the Class D tenant, where they're working possibly at someplace like a Walmart or a Target, whatever that may be, and maybe they're not making as much money as the white collar workers that typically will rent the Class A buildings, so to speak. So 95% for apartments and multifamily. Let's move on to industrial REITs. They've collected 96% of the typical income that is to be collected. Industrial, you're talking warehouses, which is expected because of the rise in e-commerce, right? Obviously, we have big companies such as Amazon. A lot of private companies are doing more so delivery as opposed to actually getting retail. Let's go ahead and talk about office space, right? So office space actually collected a little bit more surprisingly than what I thought. They collected 92% of their typical income. So office space, obviously a place like we're in right now, right? The studio that where I'm filming this video from is office space. Now let's move on to the investment classes that really took a big hit, right? So let's go ahead and start with freestanding retail. Now, what do I mean by freestanding retail? I'm talking about the strip malls, right? So maybe you've got a strip mall and you got an anchor tenant that's like a Target, and then you've got, Mrs. Jones Flowery Shop, and then you got a Jimmy John's, and then you got this. So they collected 70%. So they had a 30% decrease in the typical income that they would receive in any other given month. So meaning that if they collected $100,000 in January of 2020, they only collect $70,000. They collected only $70,000. Now let's move on to shopping centers. So now we're talking about malls. We're talking about individuals where, they're pretty much going to shop, right? The name pretty much explains itself. They've collected a whopping 48% of the typical income, meaning that if in January 2020 they collected $100,000, in April they collected only $48,000. Now, obviously, guys, all of this is connected to the huge drop in retail spending and consumer spending, I should say. There's been a 14.6% drop between the month of March and the month of April in consumer spending. I can't imagine what that number is going to look like in May because, guys, the idea, what's going on right now, and Sam's been doing a great job putting out a lot of content on the stimulus, on PPP, on IEDL, right? He's been doing a phenomenal job. But based on my observation and the research articles that I've been reading and a lot of individuals that I've been talking to, people are getting their stimulus checks and they're not spending it. They're not going out to those stores. They're not ordering things online. A lot of things are not moving as much. So I honestly would not be surprised, guys, if that consumer spending number drops even more for the month of May, right? When these numbers come out in June for the month that we are in currently, I wouldn't be surprised if that 14.6 percent number increases drastically. So let's go ahead and move on. What does all of this mean, right? We talked about the residential market. We talked about commercial, right? We talked about how there's 14.6% drop in consumer spending. Well, what does this all mean? What is most likely going to happen? So guys, I don't have a crystal ball in front of me. I don't have an 8-ball. I don't have an oracle that I'm able to call up and ask, hey, what is the dealio? But I do know patterns. And although history doesn't exactly repeat itself, it sure does have patterns. Here's what I do think is going to happen. We all know if you're watching this video, it means that you're pretty financially aware, right? You're putting at least for the effort to knowing and doing the research, which I applaud you. But let's talk about what's going to happen and what happens every single time a recession happens. We know that based on what's happening with mortgage forbearances, with not only commercial real estate and also residential real estate, we know that the defaults are most likely going to happen in 3-4 months when banks realize that the average American doesn't have the money to pay the furloughed or the forbeared mortgage expense. There's going to be a lot of defaults that are going to happen on the residential and the commercial side. So what does that mean? It means the default rates are going to happen. Let's also consider something else. A lot of these big real estate companies are having what's known as dry powder, meaning that they have billions and billions of dollars saved. They're sitting on the sidelines right now and they're waiting for the sellers to crack. And I say it all the time in this channel, but the uneducated buyer of today is the motivated seller of tomorrow. And guess what? A lot of these big real estate companies know exactly what I'm talking about as well. And they've been saving. Matter of fact, I got this number for you. It's $32.8 billion right now in cash reserves among just the private equity industry. So I'm not even talking about real estate companies. I'm not even talking about hedge funds. I'm literally just talking about private equity companies that literally have right now $32.8 billion. And guess what? They're not spending that money. They're waiting for this thing to crash. They're waiting for the opportunities to come. They're waiting for the sellers to crack. Now, guys, keep in mind, the crash technically has already started. We're in it right now. Matter of fact, if you look at what's happening in Europe and many parts of Asia, the commercial real estate market sales volume has dropped 65%, meaning that the transactions, the volume of transactions that's happening in the commercial real estate market for Europe and Asia has plummeted 65%. Now, guys, in the United States, we are no better. The commercial real estate market in the United States of America, right? Land of the free, the home of the braves, right? The country that you and I are living in right now, or perhaps you're a foreign watcher. In that case, welcome, right? But it has plunged 71%, guys, in the volume of transactions happening in the commercial real estate market today. 71% drop. So let's talk about what does this all mean, right? What does this all mean? How do we take advantage? Because I do believe what's going to happen is that the large commercial real estate, such as the hotels, the office complexes, the 500-unit multifamily, I truly believe that a lot of these big companies, whether they're the private equity group that has $32.8 billion, the large real estate companies such as Blackstone, Brookfield announced they have $60 billion in cash ready to be deployed for when the real crash happens. These guys are the ones who are going to take advantage of the 300, 500 unit apartment complexes, the hotels, the retail centers that are hurting, that are bank owned. These are the guys that are going to spend those billions of dollars buying them. So what does this mean for guys like me and you? Because, well, let's face it, last time I checked, I don't have $32.8 billion. But I think history and patterns will show you that not only these large real estate properties are going to go under default and foreclosure, having to be saved by these big real estate companies, but a lot of these sellers who own these 3 flats, the 4 flats, the 12 unit apartment complexes, the 30 unit apartment complexes. A lot of those guys may be in the same boat as well. So this is again where you and I have to be very keen. We have to be very advantageous of the opportunity. Now guys, do I wish losing a property on anyone? No, I don't. But at the end of the day, it is what it is, right? I mean, I literally remember spending all of 2016 and all of 2017, literally 3-4 years ago, telling everyone to have equity. Guys, don't refinance and don't take the liquid to buy another property. Don't do it, because guess what? These commercial lenders are looking at your loan to value ratios right now as we speak. The asset managers at all these banks are looking at your guys' equity position. And guess what? If you're not paying your mortgage first off because your renters did not pay, you're gonna get defaulted, obviously, right? That's a given. But also, if your loan to value ratio is a little bit too high, they may start reevaluating the risk of the note that you have currently with them. And guys, I know what you may be asking. Well, Daniel, what if I continue to pay my mortgage? What if I'm faithfully paying on time, et cetera, et cetera? Now, guys, maybe you're talking to different experts than I am, but as far as I'm concerned, all the commercial lenders and asset managers that I've been talking to at different banks around my local area, at least, are saying that as soon as that loan to value ratio gets over 100%, we are making calls to the individuals who hold that note, and we're asking them to provide the liquidity to get that down to 80% loan to value ratio. Meaning that if you have $1 million balance remaining on your commercial loan and all of a sudden your value of real estate goes below that $1 million, they're gonna ask that you fork up that cash up to the point where the remaining balance of the loan is at least minimum 80% of the value of your real estate. So again, guys, I've been saying that for, literally 3-4 years ago. And well, the people who didn't listen, right, who people who said, you know what, forget you, Daniel, I'm gonna buy those inflated multifamily apartment complexes anyways, right? Well, guess what, guys? Now they're beginning to feel the burn. Now they're beginning to feel the pressure of the situation that they put themselves in. So let's end this video right now with some action steps. What are some things that I recommend that you guys do? Well, number one, if you guys want to acquire properties for cheap, for 30, 40, 50, 60 cents on the dollar, and you want to be opportunistic about what's happening right now, I'd recommend you get very familiar with a couple strategies that are very recession friendly, such as short sales, such as owner financing, such as subject to acquisition. And guys, we've actually been putting out a lot of videos on what is a subject to, what is a short sale on this YouTube channel. So feel free to go ahead and check that out. Another thing that I would do right now is I would actually be raising capital. Now, why would I do that? Well, number one, you want to be opportunistic. You too want to have ammo for when the time is ready. When the opportunistic time comes, you want to have the financial capabilities to be able to take advantage of that. So raising capital right now is the one thing that I would recommend. Because why? Because a lot of people are keeping distance from the stock market. They're socially distancing themselves from the stock market because they just don't know when this thing is going to crash, along with the bond market, along with a lot of different funds are going to be affected by what's happening right now. So a lot of people right now are actually interested in real estate more than ever. It would be my argument. So now is the perfect time. But of course, I have to stress the question. Make sure you're in a position where you're able to do things with that capital. Guys, buy those courses, right? Watch the YouTube videos, read those books, educate yourself on real estate right now. That way you're actually able to raise the capital and know exactly what to do with it. Guys, I'm not being mean when I say this, but based on all the traveling I've done, based on the hundreds and thousands of aspiring real estate investors that I've seen in my career and I've trained, probably 95% of all of them do not deserve to raise money. Meaning that if I was a private lender, if I had, let's say, $1 million, hypothetically speaking, in my bank account, and 100 people came to me, 95% of people I would turn away because I didn't think they were ready and they don't know what they're doing. So again, guys, buy those courses, listen to the videos, read those books, listen to the podcast. I've got a podcast called The First Deal Experience where I literally bring on successful real estate investors and have them share their first deal experience. So check out these resources that are completely free to you, right? So click on the links in the description below if you want to check all the stuff out. So hopefully you guys enjoyed this video. I'll give you guys another update here very soon. And until then, I'll see you guys in the next one.